You're listening to The Real Well Show with Kathy Fettke, the real estate investor's resource.
New home construction versus job growth. So we like to make sure that there's not overbuilding happening in any area. But also, if there is home construction, but it's in line with job growth, that can be great. But if if you can do a phase one of a new home development, then usually they raise prices over time, and so you can make some money just from that. It's not guaranteed by any means, but it's usually the way it is. Builders start low because they need to sell those first homes to kind of get things up and running and get the construction loan, and then prices go up. So that's a wonderful way. But also, if you buy an existing home nearby for less than it costs to build, which almost any existing home costs less than the cost to build these days, because the cost to build has gotten so high, it's out of control, up 30%. And like I said, construction workers are demanding more, so prices are going up even further. So if you own an existing home next to a new home construction area or new home development, you're probably going to see your values go up as well. And then, of course, any areas that have millennial and baby boomer appeal, you want to buy property where they're going. And it seems that wherever the millennials are going, the baby boomers appear to be following them, because we're the first generation not the first, but we are a generation of baby boomers who really love to be with our children and grandchildren. And so if you follow the millennials, you will most likely be following the baby boomers as well. And otherwise, the baby boomers are going to be either staying put and remodeling because they just can't afford to leave, or they will be going to low state income tax and sort of vacation areas. And like I said, low state taxes and landlord-friendly states. That's really important for the best yields. We already know, and if you don't know, you need to join our academy. For $10 a month, you can find out all about this. We have CPAs that have given us presentations that we upload. We put them in little 10-minute segments on our academy. You can learn all about the tax benefits and asset protection of owning real estate. But we love it for that reason. The tax benefits, the control, flexibility. You can buy it, sell it when you want. You can refi it when you want. Nobody's skimming the profits. You get all the profit. So just many of the reasons we love owning real estate, and it's a hard asset. And then if you're just too busy, you can invest in a fund. We have, for those of you who don't know, we've started a buy and hold rental fund where we're doing that whole job for you. Very, very excited about that. It's probably going to be closing out soon because we've had a lot of interest in it. But this is a way to get even more diversification, because let's say you invest $50,000 into a fund, and that fund is buying about 100 properties because other investors are in. Now your money is kind of spread among 100 properties. So you have that kind of diversification. You have professional management watching over it for you. If you're one of those people that says, yeah, I get all of this, it makes sense. I want to invest in Florida, I want to invest in Ohio, but I live in California or I live in Australia. I don't want to own property and be a landlord so far away. I totally understand. It's doable. Lots of our members do it. I do it. But there can be issues. So one of the things about the fund makes it so desirable for our international investors is that it's professionally managed by our team, by Tim Horvath, who is our affiliate manager. So he's already working with all these different affiliates across the country, and now he can make quicker decisions than our members can. He knows a good deal when he sees it and is going to be visiting those markets regularly. So there's just enormous amount of benefit there. You get a preferred return, so you're getting a steady return. And you don't need to qualify for financing for yourself. So if you're not in a position to get financing, or you have too many loans, or you just don't want financing, you don't have to do it. The fund gets the financing. Plus, you still get the tax benefits because it's in an LLC, which is a pass-through entity. So you still could get the depreciation. Talk to your CPA for sure, but that's one of the benefits. I wanted to make sure you knew about it, because that's one of the things I hear a lot is I agree with you, but I don't want to be a landlord. I'm showing this slide because we are in a very similar place as we were back in 2006. I've been saying that a lot. You can see here, the blue line is the US. Prices really peaked. Like today, we're kind of up there again. But there were markets back then in 2006 that weren't peaking. You can see here, Texas was a very flat-lined real estate market. In the biggest housing boom of the US, look what was happening in Texas, kind of a lot of nothing, which is great. It's not so great when this is happening, but it's really great when this is happening. So at the time, we were helping people who owned California property. We were helping them sell at the peak. California property was up here. And so they'd sell it and they would buy Texas property. And when the crash happened, they didn't lose their assets. If anything, rents increased in Texas because of job growth. And then look what happened since then. Prices have actually been going up in Texas. So this is exactly what we're doing today, looking for the new Texas, because Texas prices have gone up now. They've gone up. So you're not going to get that kind of trade now where you sell. We're looking for places that are still down here. And I show this because I thought it was interesting that when I was asked to debate Robert Schiller, he said, this was the debate right here. It was at this time, at the lowest part of the low, that he said it was dangerous to buy a home at that time, that it was risky. And I said, that's craziness. You're at the bottom of the market. How can, with the lowest home prices and the lowest interest rates, how could you lose? And sure enough, I mean, prices have just been on a tear ever since. Now, I show this because so often we get our advice from people who don't really do the business. I mean, in this case, sure, Robert Schiller has the Case-Shiller Index, so I guess he understands real estate, and he's a Nobel Prize winner, so he knows the economy. But in this case, he was wrong. And who was I? I was just somebody who buys real estate in California, and I understood this. So I'm leaving you with this. I've shown you a lot of slides. I like to make predictions. I'm oftentimes right, and a lot of times I'm not. I thought the stock market would have crashed by now. That has surprised a lot of people. Nobody knew it would do what it's doing, and I'm sorry if I gave anybody some information that did not serve you, but it just didn't make sense to me. But I understand that we're in a world that doesn't make sense because there's so much corruption, so much manipulation, so much that we can't control, that it's very, very difficult. When you look at fundamentals, it almost just doesn't matter anymore. It just doesn't make sense that the stock market's doing what it's doing, but it is. And so we just have to make the best decisions for ourselves and look at the charts and decide, how can I make money while also being very cautious and protecting myself. So here's just some of the markets that we think have great, it's a great place to buy today, great yields, landlord friendly, all the things that I mentioned. Of course, you probably already know about that. You can speak with one of our investment counselors to find out more, to meet the teams that we have there. We have Tim Horvath, who goes around to these different markets and finds people who have ins with different realtors, and wholesalers are able to get properties for discounts, and they have teams on the field that renovate them to rent ready condition, in some cases like new or brand new, and they have property management in place. So Tim goes out and finds different teams that have a great track record and builds that list, and we share that with our members. We do webinars every Thursday, and of course you can get access to those at realwealthnetwork.com. When you become a member, you can look at any of our archived webinars or talk with an investment counselor or go on one of the tours and check out the area to be able to acquire income property before prices get any higher and cap rates compress more. All right.
Okay, so first question is, student loans, all part of the easy money approach? I'm with you. It doesn't make sense. So that person was agreeing. Hi, Kathy. Fannie Mae raised debt to income ratio to further expand mortgage. Will this delay the market pop?
Yeah, that's the idea. I mean, this is what they do. The numbers don't work anymore, but you got to keep the economy going. So what are you going to do? Well, you just make it a little easier. So, okay, we're gonna accept that you have more debt and a little bit more difficulty making the payment, but we're not going to sell the houses or get rid of loans otherwise. So yeah, no, it will delay things. There'll be more and more stimulus. That's why you just kind of have to look back and say, did the crash didn't really happen till 2008. So, but you could hear rumblings around 2006. So you could have sold your property in 2006, 2007, even maybe early 2008 and come out okay. So the question is it going to be this year, next year? At some point, there's going to be a correction. You could be a year ahead, 2 years ahead. That's why it's just really important that with any decision you make, you just know something might be around the corner. It might not be. I mean, some people think that it's not true, that we're just at the beginning of a boom, and that could be. So you can play defensively. And one of the ways that I was trying to explain that with that Texas video, with the Texas slide, was if you sold your property in California in 2006, if you listened to my advice back then, and I helped you sell your property in 2006 and exchange it for properties in Texas, you would have quadrupled, even quintupled your cash flow and made equity growth. So even if there was never a crash, let's say there was never a crash in 2008 and you did that, you'd still be great. You'd still be super happy because you have all that, all that cash flow. So, you can play to win either way. And that's what's important. What you don't want to do is make decisions that could really hurt you. So I'll give you a couple of examples. With our fund, I told you about our real estate fund. We have to make some really hard decisions because, in a fund, I am instrumental in managing your money. I mean, that's really what it comes down to. If we introduce you to a company that's selling properties, you're at the end of the day, you're picking that property and you're deciding, and it's all you. But when it's a fund, it's honestly, it's all me. I have to take that responsibility, and it's scary. So I have to be able to say, how do we make people money and save, protect their money from any kind of loss if there was a downturn. But what if there's an uptick? I don't want them losing out either. So what do we do? Now, one way that I could put people at risk is if we over leverage. And so when we first came out with the numbers, we were looking at a 75% LTV on the fund, and I'm not comfortable with that anymore. I don't think that's wise. If we went into a massive downturn, you don't want to be in debt. You just don't want to be in debt. So an example with our Reno properties that we're building, Fred, he's been doing real estate for 40 years, and he refused to go in debt. Not at this stage in the game, not at this part of the cycle. So we raised the money together as a network. We bought the land with cash. We're going to sell some of the lots, and we're going to use that money to build the houses that we're going to keep, and we're staying out of debt. Now, there's some situations where debt might be okay, where it's safe, but you have to be able to make those payments. So we're still going to leverage the fund, but it's not going to be at 75%. Because there could be that downturn. So I don't even know what the question was anymore, but I hope that answered it. All right, next one.
Okay, next question is, could you talk briefly about RWN multifamily investments? Is RWN going to invest into apartment-like syndication projects?
Yeah, we are at the part of the cycle where first of all, we wanted to find out if our members wanted that. And we had an overwhelming response. Yes, yes, yes. People want apartments. Where we are in the cycle is nerve-wracking to me. People are paying too much for apartments. Cap rates are really low, but there's desperate need for them. So if we can find apartments that make sense, we'll do it. Right now, Fred in Reno, our developer there, has been negotiating for probably 6 months on some land where we would build an apartment, and that would make a lot of sense. In Mountain View, we bought an apartment at one cap for 200, had 200 units, and we're re-entitling that to about 800 units. That makes sense. There's going to be, we didn't just buy it for the one cap. We bought it to redevelop and make money that way. So it just depends. Right now, I mean, we get apartments that come across our desk all the time, and we turn them down because there's not enough in it. And the one apartment we invested in, it's been brutal. It's been really, really difficult. So I don't want to go through that again ever. So we're only going to do deals that make sense. However, we do have a huge network. So one of the things that we were considering doing is just listing apartments. Kind of like just having a page on our site where If we see a deal, maybe we are going to pass on it, but maybe you want it. And so we were going to just kind of stay out of it, list it, and see if anybody else can make sense of some of these numbers. So that's why we wanted to gauge our audience if there was interest, and there really, really was.
Great.
So, all right, next question.
All right, here's a good question. What do you think is the best opportunity or some of the best opportunities for preserving wealth in an upcoming market crash? What are some of the ideas that your advisors are telling you, and how do they differ?
Well, yeah, I mean, I interview these kinds of people on the Real Wealth Show all the time, and I mean, offline and online, I'm always asking, what are you doing? What are you doing with your money? I need to know, because it's scary. I mean, many of the people I listen to say they think there's going to be a full-on crash, that banks are going to just be completely wiped out, U.S. banks. So some of the most fearful people I listen to are not holding cash in U.S. banks at all. They're either holding gold or they're in banks outside of the U.S. I haven't done that. I'm still trusting the system, but I'm on their red alert list. And I think you do. And since I'm on their list, you're on mine. If there seems to be any grumblings, or I should say rumblings, that point out that maybe it's time to get your money out of the banks, then I will certainly let you know. As you may or may not know, there was nearly a full banking collapse in 2008. And from everything I've been taught, your money in the bank will not be there for you. There's legislation that basically protects the banks before you. And so if you're just a regular depositor, you're the last on the list to get your money back. So it's really not a safe place to have your money. It's very concerning to me when we do syndications that we have that much money in a bank account. That's why as soon as we get money, we buy the land, we get it out of the bank account. So, for me, you're going to hear what I'm about to say, which is I don't want my money in piece of papers that have zero value. I don't really want it in gold either. I mean, I think you're supposed to have a little bit. We have a tiny bit, but, I would want to have things of value. So some of the things that, from the very fearful people that I spoke with, the Robert Kiyosakis, the Peter Schiffs, the people I hung out with on that investor cruise in April, they are buying stuff. They think there's far more value in things. So they're filling up their garages with things that would be tradable, far more tradable than gold or silver, which would be food, or water or cigarettes or booze, anything that people are going to want during a recession. So they're stacking up on that. They also are piling up cash, and real cash, like hiding it in the house. I don't have their home addresses, or I give it to you, just kidding. But they are, taking a little bit of cash out and just having that ready and available. And of course, I always say, well, what about housing? What about housing? And usually the response is stay out of the high price stuff, stay in not low income, but the average income home price, because those properties fared pretty well during the recession, like I showed you with the Texas slide. There really wasn't much of a recession there, at least not in the places where we were buying, in the kind of nice suburbs of Dallas, up and coming areas where we paid no more than $150,000 for a brand new house. Those properties only went up in value during the recession. So that's what I plan to continue doing, is just, if there was a massive recession and people lost their jobs, they still need a place to live. However, rents will go down. There will be, that's what will happen. So if you buy property, you have to be able to sustain lower rents. And so if you get too highly leveraged, you can't really lower your rents too much. That's when you have to fire sale your property and take a loss. So, stay low leverage. I love leverage, but just be able to make those payments. Have enough reserves set aside that if you have to lower rents in a downturn, you'll be fine. Okay. Oh, and then also investing out of the country. Our July event, we're going to bring in 4 different groups who have properties outside the country. So I think a little just kind of, diversification outside the country is good as well.
All right. Let's see, next question. For people with good credit but can't qualify for conventional or FHA loans but want to invest in real estate, are there any solutions for them?
For sure. I'm actually having dinner with the VP of Colony Finance on Monday. So I'm going to have a lot better answer for you on Tuesday. But I could tell you that he is coming all the way out to Malibu to meet with me and wants to give our investors a deal. So I don't know what that means yet. All I know is that he knows we have a lot of people who want those loans, and basically they're blanket loans. They want to finance our fund. So if we say we raise $5 million for our fund, they would give us $5 million. So we'd just be 50% leveraged, and they're excited about that. But I said, well, what about individuals? What about foreign investors? Can you do that too? And they said yes. So I'm going to have some really great news for you next week on that. So definitely stay tuned, and I'm sure we'll do a webinar on the topic.
Great. Speaking of the fund, there's a lot of questions about that. So to narrow it down, most of them are just asking for more information. So what's the best way to get more information on the turnkey rental fund and distressed property flip fund?
Great question. What I'll do, I think we've done a bunch of webinars on it. So I would watch the webinars first. They're recorded. It'll show you how it works. But basically, we're giving an 8% preferred return, and then splitting the back end. So basically, what makes this great is that it's such a difficult time to get property. I mean, everybody is clamoring for property. But we, as a network, me in particular, and Tim, have the inside scoop. We kind of get to be first. And I've never taken advantage of that. If I've ever bought property, I've always bought the leftovers. Now, for the fund, there are properties that, our investors just can't move quickly enough on. You just can't. You're here, they're there. How would you be able to do that? So we're going to be able to move on properties before anybody else. And I don't mean anyone from our network. I mean other people buy those properties. And then we also have a lot of mom and pop type turnkey providers that are just too small to handle a lot of investors, but we want to work with them, and they have great properties, but we just have never been able to introduce them to our members because they would get overwhelmed and then their quality would suffer. We've seen that happen because they just can't keep up with volume. But for the fund, we're finally going to be able to work with these people and acquire some really great properties that nobody else knows about in markets that nobody knows about. So that's just some of the information. I promise you, we're not going to compete with our members. Our members always get first choice at properties, but we have some affiliates that are separate from our normal affiliates that we'll be working with. All those details are on the webinars.
Yay. Okay, I've got a question from a millennial here. He says, hi,
All right.
I'm 24, living in Dallas, Texas. I've been renting for 2 years since I graduated college, and I'm debating moving into a townhome house and subletting out other rooms or investing in a rental property while maintaining my current rental situation. What would you suggest?
My first choice, it depends on you and your money and what you like to do. But if you don't mind living with people, and if it makes sense in Texas, I'm not sure if it does, but if you can get a duplex or a fourplex and it's in a desirable part of town, it's not in a dumpy part of town, then I would do that, because you can get an FHA loan, get a fourplex, only put 3.5% down, live in one unit and rent out the other 3 units. You do not have to live there forever. There's no limit, there's no time frame where you have to live there on an FHA loan, but you have to live there for a little while. And then you've acquired a fourplex that, from what I've seen, you could live in your unit probably for free or even be making an income renting out the rest. So that would be my first choice. I presented that to my 24-year-old daughter, and she didn't want to do it. I showed her a couple of fourplexes in her part of town, and she just didn't like the neighborhoods, didn't want to do it. So instead, she found a property. I'm so proud of her. I'm about to do a show on it. I just interviewed her. She's 24 and is buying her first property. And she did do the 5% down. She did not do FHA because she has great credit. But Fannie and Freddie will do 5% down loans now. And she's just renting out. She's actually not going to rent out the other room. She's getting a second job because she doesn't want anybody else living there. So she's just going to get a second consulting job. But it's a 3-bedroom, so she could rent those other 2 rooms out. So again, it just depends on you and your lifestyle. But you do have, as a first-time buyer, you have this FHA loan possibility of buying a fourplex with just 3.5% down. So if you can find a good one, and that's the key, if you can find one that you actually would want to live in, then that would be the way to go.
All right. There are a few people that had asked about Detroit because it wasn't on our list. So they just wanted to make sure we We're still promoting the
Oh, I'm so glad you asked. That must have been an old slide. Yeah, Detroit is very, very, very high on our list. We like it a lot. Detroit feels to me like Cleveland did several years ago when we bought. I haven't bought anything personally in Detroit yet. That's not because I don't want to. It's just because I've been too busy. But I think it's a up and coming market. It's so cheap. You can get a great deal, and I really believe there's going to be appreciation, a forced appreciation, basically a bounce back to what prices were. So I think you can get cash flow and appreciation. It feels like when we were buying properties all done, all renovated in Cleveland for $50,000-$60,000 and renting them out for $900, that you can't get that in Cleveland very well today. It's harder, but you can in Detroit. So yeah, I'm bullish on Detroit.
All right.
Certain neighborhoods, you got to be careful. There's a lot of bad neighborhoods too. Don't go to those.
So what are your thoughts on the Miami housing and what you think the current administration's policies will affect, how that will affect the Cleveland market?
Miami is fun to visit. I wouldn't personally invest there. I don't think you can get great returns, but I'm sure there's people who do and do fine. But for me personally, I like other parts of Florida better, and for investing, higher cap rates and higher chance of appreciation. The current administration's effect on Cleveland, I don't know that there would be any. I don't know. I just see that Cleveland is growing and investing itself. It's a medical hub. I see the future is medical, so I think it's a strong market.
Great. One person had a question about maintenance. I'm concerned about maintenance on properties after purchase due to the labor shortage. What is RWN's strategy for containing costs?
Well, it is a great question. We like to buy properties that are already renovated. All the big ticket items have been done. This really mitigates your risk because you know you don't need a new roof or you don't need a new HVAC or anything like that. It's already been done. So your maintenance should be just little repairs. But the property manager handles that, and they have a staff. So yeah, I mean, will costs go up? Yeah, probably. But that's why we like to buy turnkey properties that have been already renovated.
Okay. If the window of time to find solid cash flowing opportunities is coming to a close in this market, would it be more worth the effort and time to look to maybe flip houses for a while?
There are certain markets that are great for flipping. If you're in those markets, then great. But depends what market you're in, and you've got to be. If you don't know how to do it, I wouldn't jump into it now. If I did, I would do it with someone who's got a track record. I would never try to flip a house without experience or with someone who has experience. With that said, I would only do short-term deals. I would not do anything that was going to be a major rehab. I would want to be in and out in 3 to 6 months, just because, if you're stuck with a property that isn't going to cash flow and the market turns, then, you might have trouble selling it. So always make sure that in your numbers, you adjust for the possibility that prices will stabilize or decline.
Great. What is a good average hold time per property in years, since everything's...
In years? Well, it just depends. If the property's cash flowing, then, why sell? You can always refi. If you get to a point where the property has gone up so much in value and maybe is in a bubble, maybe it's a good time to sell because you could sell it before that bubble pops and go buy in a market that's not in a bubble. So that would be probably the only reason I would sell. The other reason I might sell is if that property is just not performing, if it's just been a hassle. Sometimes that's the case. It's just maybe not the right corner or not the right neighborhood or whatever, or the neighborhood's changed, then you'd sell. Otherwise, if it's performing, keep it.
Wonderful. So I did a lot of compliments, by the way, Kathy. Everyone's saying thank you for all of that. Great webinar today. You're my hero.
Aw, thank you.
One person had a question on your thoughts on Oklahoma City and what is a good exit strategy for...
Okay. Oklahoma City is a great, solid city. It never really dipped. It never really goes up or down. So there is a little bit of a dependence on oil. So do factor that in. we've just never really invested there because we weren't really finding that great a deal, simply because prices, we like to buy distressed property and make money on them, and just for us, Oklahoma City just didn't ever go down in value. So it's a great stable market. I'm going there in a couple of weeks for a wedding. Got family there. So good market. I don't know that you'll ever see appreciation there. And so if that doesn't matter to you, then that's great.
What do you think of Section 8 in general and with the Trump administration?
Well, who doesn't want the government to pay you every month for your asset? I mean, it's a wonderful concept. It's terrible, in my opinion, for our country. I think anytime you offer things for free, people don't appreciate them, and I don't think it's best for our country. However, as an investor, who wouldn't want the government to pay you, for your tenant's rent? It's wonderful, steady income. The thing is, it's not real market rates. So if anything were to happen to that Section 8 program, then now you don't have it. So that actually happened to us. I can't remember which city right now, but I want to say like it was either Kansas City or Indianapolis. It was somewhere where we were really active in the Section 8 program, and then all of a sudden it was just discontinued. And all of a sudden people had all these properties that the government was no longer, making the payments on. And so it went to market rents, and they weren't really the nicest part of town. So it's not a permanent thing. It just depends on the administration. And if an administration is going to take that away, then you need to be cautious. And right now I'd be cautious given our current administration.
Okay. What is the current return on our real estate fund right now?
Return? Our real estate fund, we just started, so we have no return. How's that? We are just now collecting money and buying the houses. We were able to buy our first batch of houses. So in about a month or two, we'll be able to tell you what that return is. We can show you the houses that we're purchasing and what they're renting for. They're actually just unbelievable. Some properties in Florida for around, I think they were $140 and they rent for $1,800. Just really fantastic deals. So the returns are going to be nice, steady, and that's what we believe. And then we're also buying. I'm from California. I like appreciation, so we're also buying in areas where we expect there'll be some equity growth as well.
Wonderful. Can I invest in REIT without being an accredited investor? And are self-directed investors in your fund subject to UDFI?
We don't have I don't know if it was a REIT. We don't have a REIT. It's an LLC. It's a fund. And if you're investing with your IRA, there would be unrelated debt. There'd be unrelated debt finance. Yeah, UDFI, because we'll be financing. So you would be taxed. We have private money lending funds where that's probably better for your IRA. So let us know if you are interested in that. Anytime. Our flip fund it's going to have UBIT because it's business activity, and our buy and hold fund is going to have leverage. And so really the best bet is probably private lending. All right.
All right. I think we got them all.
All right, Jill, thank you. And thank you all so much for your great questions and for being here. We had a great turnout. I'm sure there'll be more questions, and you can send them over to info@realwealthnetwork.com. I think there it is. Look at that slide. All right. That's how you contact us, but probably most of you already have. If you haven't met with one of our investment counselors, I highly recommend it. They're just going to kind of look at you, your situation, your finances, and help you strategize what might be the best way to help you build and protect your wealth. So have a wonderful rest of your day. Thanks for joining me, and we'll see you next time. Bye-bye.